Now let's take another example of a dealer who initiates a dollar-yen position just to make the concept clearer of how FX swaps are initiated in the market. So we will demonstrate the initiation of the trade, and then you can square the trade later on using the FX swap concepts. Now the dealer has taken a position for value spot. So he has bought dollar-yen 1 million at 113.20. So the cash flow would look like this: plus 1 million in the dollar account and minus 113.20 million yen in the yen account, a debit. Assuming that the dealer is in the money and wishes to leave his position open, the next day his position will mature on T+1 and he will need to pay out 113.20 million yen. Now he can either square this position value term or he can continue to run the position. Let's assume the dealer is deep in the money and he wishes to continue this position. He would need to then swap his cash flow maturing tomorrow to a later date. Now he can either swap this cash flow on a daily basis. So he could either swap it, he can either perform a term next swap and then continue to repeat the term next swaps. But funding positions daily is expensive, much more expensive than funding positions over 1 week or 1 month. So typically a dealer would swap his cash flows for a month and continue to keep his position open. Now in order to do that, he would need to perform a foreign exchange swap. Now this is done by simply selling and buying dollar-yen 1 million value term over 1 month. The cash flows would look like this. Now we can see that the dollar-yen 1 month forward swap points are minus 12.98 and minus 12.11. So the 1 month forward rate for dollar-yen is quoted 12.98, 12.11 pips discount. However, this is spot over 1 month. We really need term over 1 month, but for now we'll just keep it simple and we'll use the spot over 1 month rate. His new cash flow statement would look like this. So his initial position was plus 1 on the dollar side. Now the dollar will be squared because of the sell-buy swap. So the dollar is square, the yen is square, and the cash flows shift from spot to 1 month. Since the dealer initiated a sell-buy swap, he receives a discount. Now in order to get the price for the swap, in order to get this 113.08, we need to understand which side of the swap we need to hit the dealer at, the price maker at. So the dealer who's performing the swap is the price taker. In order for the price taker to know which side to hit, the price taker has to understand whether he needs to pay or receive the swap points. Now in this case, dollar-yen is quoted at a discount and the dealer needs to sell buy the swap. So if he sell buys the dollar-yen which is at a discount, he will be selling higher and buying lower, and therefore he will be receiving the discount. Now obviously, since the dealer is the price taker, he receives less, which is 12.11 pips. So we can round that off to 12, and therefore the dealer can price the forward leg of the FX swap at 113.08. If the dealer did a buy-sell swap, he would have paid the discount because he would be buying high and selling low. He would therefore need to pay 12.98 or roughly 13 pips as opposed to 12.11 or roughly 12 pips. So we can see from this example that using an FX swap, the dealer swaps his cash flows from spot to 1 month forward, and therefore he does not have to worry about funding the Nostro account or the local currency account on account of his position. So now, as a simple exercise, assume that the dealer squares off his position 1 week from now, so T plus 1 week, at a 113.80. As an exercise, you can show the dealer's cash flow in a spreadsheet and use the T plus 3 week dollar-yen swap rate provided to square the dealer's position. So pause the video and then look at the solution.